Hello, good afternoon. Good afternoon, Gail and Serin. Serin Legend. Serin Legend, where are you from? Good afternoon. You are there? Serin, you are there? Can you guys hear me? Gail, good afternoon. You are there? Good afternoon, Myungsub.
Afternoon, sir.
You are from Daejeon, Myungsub, or a different city? Myungsub, you're from Daejeon?
No, I'm from Sejong City.
From Sejong City. Oh, okay. So you come to school from Sejong or stay in Daejeon, Myungsub?
I go to school from Sejong
Okay. By what?
by train and bus.
Train and bus. How long do it take?
Like 30 minutes to Daejeon Station, Daejeon역.
Uh-huh.
And like if I take bus, it's
Uh-uh.
10 minutes
Yeah.
to the school.
Yes. Pretty close from Daejeon station, right? I see. Yeah. Not bad. Okay. Relatively close. Okay, it's possible. Yeah. From Sejong to Daejeon. Yeah. Because the school is pretty close to the train station, right?
Yes, that's why it's possible.
Yeah, right. Good afternoon, everyone. Good afternoon, Wang Jia. I can see your teddy bear. Teddy bear is holding up his hands or her hands. Okay. Okay. Did you guys have a chance to take a look at the answers to the questions that I sent you? Any questions? Because that is included in the coming midterm exam, right? So these days, the skies are really high and blue, right? So that's why I took this picture from the internet. So there's, I think the sun is hiding behind these clouds, right? So this is maybe called the silver lining. So whatever difficulty you may have, there's already silver lining behind that, right? So it's gonna pass and a good time will come, right? Chojin, you are there?
Yes, I'm present.
Yes, sir.
Ah, yeah.
Did you say Chojun? Cho-
Chojun, Hyojin.
Oh,
It's
sorry.
pretty similar. But nice to hear your voice, Chojun.
Yes, I'm sorry, sir.
No, don't have to say sorry. So Hyojin, did you take a look at the answers to the questions I sent you?
Oh, yes.
No,
Got that for everything.
no questions?
Not yet.
Not yet. Okay.
Yeah.
Minja, do Minja, did you take a look at the questions, answers to the questions?
Not yet. I decided to say it today. Sorry, Professor.
No, don't have to say sorry. Yeah. Okay, great. Mhm. Today, I got this news. I read this news article about the cryptocurrency. I think some of you guys, many of you guys, have interest in cryptocurrency, right? But this is kind of a big kind of advance in the cryptocurrency world, because BASF is the US accounting board, which sets accounting principles. So the BASF setters financial accounting standard board. BASF setters on fair value accounting for measuring crypto assets, right? So the cryptocurrency is going to be also recorded, accounted for as part of the asset on the balance sheet, right? So which means that the cryptocurrency is not something that you cannot value anymore, right? So many companies may have more interest in trading, using cryptocurrencies in trading or doing businesses, right? So I know the value of cryptocurrency, for example, Bitcoin has declined a lot in the past several months, but I think the prospect of cryptocurrency is not that, it's quite bright, because this cryptocurrency is going to be part of the asset on the balance sheet of many, many companies, right? Okay. So today we are going to talk about the capital budgeting, the follow-up, and project cash flows. The topics we want to have, is we want to follow up on the previous capital budgeting lecture, and project cash flows, scenario sensitive analysis, and capital ratio. Okay, so just for refreshment, what is this about? This ignores the timing of the cash flows and ignores the subsequent cash flow entirely, and takes no account of the opportunity cost of capital. What does this mean? So what does this about? This means that ignores timing cash flow. Anyway, so what is this about? Jongin, what is this about?
Payback period.
Yes, payback period, right? Payback period does not care about timing of cash flows and the subsequent cash flows. And so because this ignoring the timing of cash flows means that opportunity cost of capital is not considered, right? So if the opportunity cost we consider, then the cash flow will be discounted at this cost of capital, right? What is this? This is defined as the rate of discount at which a project have a zero NPV, net present value. This is based on discounted cash flows, and this should exceed opportunity cost of capital in accepting a project. So what is this about? Amina, Temujin?
Yes.
Okay, nice to hear your voice. So what is this about? Amina, can you recall? Okay. Who Jianan?
Yes, Professor, I'm here.
Yeah, you're from China?
Yeah,
Okay, nice to hear your voice. So what is it about? This is defined as the rate of discount at which a project should have zero net present value, and it's based on discounted cash flows, and this should exceed the opportunity cost of capital in accepting a project. What is this about?
sorry, Professor, I'm outside. I didn't hear clearly. Sorry,
Okay. So this is about what? Internal rate of return, right? Okay, just a minute. I can see Yeogyong Sim, you are there? Yeah, Yeogyong, just, are you having my emails? Yeogyong Sim? You're there? Can you hear me? Yo Kyung-shin?
Can you hear me?
Yeah, I can. I can hear you.
Yes.
So do you receive my email?
Well,
you
I
type-
don't know about the email.
Okay, so because I don't have your email address, so please send me, if you know my email address, please send me email, okay? So then I receive.
I send my email through your phone number.
Write
I
down your
remember.
email on the chatting box, okay?
Yes, okay.
Okay. Okay, this is about internal rate of return, right? Internal rate of return is defined as a rate of discount at which project would have zero net present value, and the internal rate of based on the discounted cash flows, and it should exceed its optional cost of capital in certain project. Okay. Okay. Let's try to understand it, what internal rate of return is in different way. So you guys know income. You guys know. Okay, revenue. Not revenue. Let's say income. Okay, income. XX income. Let's say 100. 100. Yeah, 100. And expense or expenses, right? So if you deduct expense from income, then you have what? Profit, right? So if you run a business, the purpose of the business is to make a profit, right? Cash flows is the equivalent of income, gross income, total income. Okay, cash flows. So when you have a project to launch, but not yet decided, so then you're gonna focus on what kind of how much of cash flows will be expected in the future. But so that cash flow may be interpreted as a gross income for the project, right? And expenses is the investment you need to make to generate the cash flows, right? So without considering the time value of money, all the cash flows is gonna be income, gross income from the project, and the expenses are all the costs needed to generate this gross income, and the profit is the difference between gross income expenses. Okay, and IRR, internal rate of return, is the rate of return, internal rate of return, right? So this is return, rate of return. Let's say all the rate of return, and then internal rate of return is the gross income that is equal to expenses. Let's say expenses 100. So then you're gonna have a profit 0, right? So if the gross income has the rate of return, some specific rate of return, right? And then if you deduct the expenses from this income, then you're gonna have a 0 profit. Okay, so that specific rate of return that makes the profit 0 is the internal rate of return. Okay. And this internal rate of return is used to discount these future cash flows, right? As you can see here. So as you discount these future cash flows at this internal rate of return, their present value is supposed to be 0. If, let's say, expenses only consist of only, let's say, interest, let's say, just assume that. If only interest is the cost of generating this income, and the interest rate, let's say 5%, okay? So then if interest rate 5%, then if you discount these future cash flows at 5% rather than 10%, then you're supposed to have a positive net present value, right? So then you're gonna have a profit higher than 0. If 100 is the income generated based on the 10% rate of return, right? So NPV, so when you have IRR, internal rate of return, you always remember that this rate makes the internal and net present value 0, okay? And you also think about cost of capital. Cost of capital means that how much of risk, how much of a cost you need to finance this project. So if cost of capital, for example, interest rate, right? When you make a loan from the bank, you're gonna have some interest rate on the loan, right? So let's say interest rate is 5%, okay? So then you need to compare this internal rate of return that makes the net present value 0 with this cost of capital, right? Because we are talking about corporate finance. So we always think about financing cost. So if the cost of capital is lower than internal rate of return, then we are going to have a positive NPV, because if the cost of capital lower than IRR, right? So that's why you always think of when you have IRR. First thing is, oh, IRR is the rate that makes net present value 0. Then we need to compare IRR with the cost of capital, whether IRR is higher than cost of capital or lower than cost of capital. If higher than IRR is higher than cost of capital, then oh, you're going to have a profit from the project. But that's what you have to think. That's what you have to get from IRR. That's the usefulness of IRR. Okay. You guys get it? This is jackpot case. We had a in the very early of this course. Here is the break-even interest rate. So the Ontario Lottery will pay you either $1,000 a day for the rest of your life, or $7 million now if you won the jackpot. Okay. The fine print tells you that lottery determines the payout frequency. Assuming a payment of $365,000, this is right, multiplied by 365 days, is made at the beginning of each year. If you only receive payments for 20 years, the break-even interest rate is about 0.545%. Of course, if you manage to invest the $7 billion lump sum at a rate of return about 5.5% per year, you can have your cake and eat it too, because the investment will return $365,000 at the beginning of each year, forever. So let's do calculation to verify numbers of using the Excel. So here, so you want a jackpot, right? So then you have two choices. One is you're gonna receive $1,000 every day for the next 20 years. So the other one is you're gonna have a lump sum payment of $7 million right now, right? So then you need to decide which one is beneficial, more beneficial to you, right? So in this case, what you need to know is, okay, what is the present value? What is the future value? What is the discount rate? That's what you need to know, because we already know the cash flows, right? From here, the cash flows, one cash flow is 7 million, right? Lump sum payment. If you decide on the lump sum payment, then you are supposed to have $7 million right now, present value, right? But if you decide on, if you opt for the daily payments, so then your cash flow is for a year, annual cash flow is this one, right? This is $365,000 per year. For 20 years, right? So this is the cash flow. So then, if here, this C is gonna be $365,000, right? So this is 20 years, 20 times 20 years. Okay. So if you take this lump sum payment rather than single, if you take this kind of annual payment over the 20 years rather than the lump sum payment of $7 million, so you give up $7 million now, right? So it's kind of the C1 is gonna be $7 million. Okay, is that right? Because if you take this lump sum payment, these annual payments over the 20 years, you give up this $7 million of lump sum payment today. So this is gonna be minus $7 million, and you have these cash flows. And yes, if you, so then depending, then if then based on these cash flows and 20 years and C0 is $7 million, then if you want to get internal rate of return based on these cash flows and in kind of investment, here investment is the amount you give up for the other option, right? So if this, so then minus 7 million and this cash flows. So if this the calculation is 0 using some specific rate, right? That is internal rate of return, right? That's why the break-even interest rate is 0.45. If you use this 0.45% as an internal rate of return, right? Discount rate, then you're gonna have NPV 0. So then, okay, at 0.5%, 0.45%, if discount rate is 0.5%, then there's no difference between lump sum payment and annual payment over the 20 years, right? But what if the market interest rate is higher than this 0.5% or lower than 0.5%, right? Then your decision will be different. Okay. So let's say in the market, if the market interest rate is higher than 0.45%, let's say 0.5%, then you're gonna have a negative net present value, right? So then this option of taking the annual payment is not beneficial to you, right? Or if market interest rate lower than this 0.5% or 5%, then your option for annual payments over the next 20 years is going to be more beneficial than lump sum payment. So that's why internal rate of return has its own usefulness in making decision in such cases. You know what I mean? You guys understand?
Yes, Professor.
Okay. So this is the jackpot case is related to, basically this one comes up in the time value money in the time value money section, but this break-even rate is basically internal rate of return, right? Why it is called internal rate of return? Because it is hidden in this cash flows, right? You should find out, like yield to maturity, right? This is hidden. Only when you know the price of the bond and all other information such as the coupon rate and maturity, then you can get this yield to maturity, right? Likewise, only when you have investment, initial investment cash flows, then you can get this rate of return. But this is hidden, so that's why it's called internal rate of return, not external rate of return. Okay, external rate of return could be cost of capital. So external cost of capital is, for example, interest rate on the loan you want to take from bank, or yield maturity, the coupon rate on the bond the companies gonna issue to the investors, potential creditors. Okay. So this is about the comparison of NPV versus internal rate of return. Okay. So if discount rate is lower than discounted rate is NPV, this R is opportunity. This is our opportunity cost, right? Opportunity cost. This is internal rate of return. So if the opportunity cost is higher than this internal rate of return, some specific rate, then you're gonna have a negative NPV. If opportunity cost is lower than internal rate of return, then you're gonna have a positive NPV. So at the end of the day, you should take a look at the NPV, right? Net present value. So internal rate of return is a kind of a internal rate of return, cash flow, internal rate of return, and then their present value. So cash flows are our future cash flows, future values, right? But I need to know what is going to be the present value of this whole future cash flows, right? So then you're going to get this internal rate. Okay, if using this internal rate, when the present value is 0, then sorry, cost of capital. Then what cost of capital is below, higher than this internal rate, then okay, the present value will be decided. So this is kind of a flow of processing the whole factors such as cash flows, internal rate of return, cost of capital, and net present value when it comes to making decision on whether you want to take the project or not. So you have this kind of mental process, should have a mental process in making use of these techniques. Okay, method. Any questions? No? Clear?
Yes, Professor, for me it's clear.
For you, clear. Okay. How about Tongjin? Tongshin. Sorry, Tongshin. Maybe from.
Yes, Professor.
Are you clear?
Yes.
Okay. You can, but internal rate of return is impossible to get using your own brain. Okay, so you should use the financial calculator or the Excel. So if you want to use the Excel to get this internal rate of return, then it's pretty simple. I think I already showed you, right? So if you go to formula, finance, and internal rate of return, okay? So you shouldn't, when you calculate using the calculate internal rate using the Excel, then this is the way, okay? This is the internal rate of return. This is the present value. The present value is first you need to calculate the present value of this future cash flows and deduct this future cash flows from deduct from this present value of the cash flows. Then you want a net present value, right? So here we have a negative net present value. So this internal rate of return is 27.27, right? And the discount rate, the cost of capital is 28%. So discount rate higher than internal rate of return. That's why we have a negative net present value. Okay. To understand the internal rate of return in this is very simple cash flows, right? So our assumption is that okay, investment, the negative cash flow or investment we made only in the early period of the time of the project, and we want to have a positive cash flow over the period of project, right? But in reality, in some specific years, you're going to have some negative cash flows, right? some years maybe have a huge amount of cash flow, not positive cash flow. But that is the situation you want to face in reality. So then, if you simply use if you use internal rate of return, then because of this positive and negative cash flow, you could have two internal rate of returns. Okay. As you can, these two internal rate of return, when you use the financial calculator or Excel, it's not easy to get two internal rate of return. You need to do some you need to set some kind of numbers to calculate to get these two internal rate of return. But the whole point is that when the cash flows, future cash flow is fluctuate between positive and negative, then it is likely that you may have two or more than two, at least two internal rate of return is possible. Okay, so multiple internal rate of return are possible because of cash flows, fluctuation cash flows between positive cash flow and negative cash flows. Okay, but don't have to calculate all the IRR. Just to make sure you understand that if the future cash flow, some years is positive, some years negative, then it is likely that you may have a two internal rate of return. So then, is internal rate of return more useful? No. So which one should you take when you have a multiple internal rate of return? It depends on cost of capital, right? As I said here, at the end of the day, whether internal rate of return is 1, 2, 3, you should already think of cost of capital. You should compare cost of capital with internal rate of return, right? So internal rate of return is just a rate that makes the future cash flow zero from a present value perspective, right? So if you have as long as you may have a cost of capital, right? So then if you have one specific internal rate of return, possibly maybe more than one internal rate, but still, as long as you have one internal rate of return, and you know the cost of capital. So as far as the cost of capital discount rate, actual discount rate to get the net present value, okay? Depending on the discount rate, you can decide whether this project is gonna be profitable or not. Okay, not wholly based on internal rate of return, IRR. So as you can see here, depending on discount rate, if the discount rate is between, in this case, two internal rate of return, you have a positive net present value. So even though you don't have this type of graphs, this kind of graphs, as long as when you have discount rate, some specific discount rate, and using discount rate, when you have a positive net present value, then you want to take the project. I mean, the product is profitable. You can decide. You can interpret like that. Okay. So internal rate of return is not the definite criteria in accepting or rejecting the project because of this kind of nature. But that present value, because net present value is always based on this cost of capital discount rate. So as long as net present value is positive, which means that the project could be profitable after taking account of the cost of capital, right? So net present value, positive net present value is always preferable. So this is the kind of using the Excel, you can, if you have interest, you can manipulate these numbers to see what happens, right? To MPB and changing discount rate, okay, or cash flows. This is the about the conflict between the present value and I. You guys have any questions about this multiple rates of return? So we are talking about the present value in conceptually pretty simple, right? As far as the present value is possible using some cost of capital, then okay, the product is profitable, right? The product is worth thinking over, right? And but if you work for a company, in many cases, the management prepare internal rate of return to net present value, right? Because it is more kind of intuitive rate of return, right? And more easy to remember, and pretty straightforward. Okay, so internal rate of return, and what is the cost of capital? What is the cost of capital? The exact the way of calculate cost of capital will be in the next lecture, over the next 2 lectures. But anyway, just assume that we have a cost of capital. So then you simply compare the cost of capital with the internal rate of return. So then much more simpler. But if you the present value, the specific amount of dollars, okay, it is possible, but it is a little bit hard to compare net present value with the cost of capital. But definitely, yeah, the meaning the cost of capital, the present value is possible is that the rate of return is higher than the cost of capital. But anyway, they prefer to use the internal rate of sometimes in many cases. So that's why we are looking into the nature of this internal rate of return versus net present value, right? Even though at the end of the day, we are going to look into whether the present value is possible after the taking account of internal rate of return, right? Okay. So one nature of an internal rate of return is it may have a multiple rate of return, but still what really matters is discount rate. Okay. So even if you have a multiple discount internal rate of return, discount rate is matters. Okay. This is also this conflict between the present value and internal rate of return also come from cash flows. Okay, so as you can see here, product A, product B. We have a product A, product B. So if you look at this cash flows of product A, product B, okay, even though their initial investment is 100, the same. Just a minute. Project A, as time goes by, its cash flow is getting lower, right? Lower, and the project B getting higher. So project A has a higher cash flow in the early years, and project B is later years, right? This difference makes some effect on internal rate of return and the present value. Okay. Product A, look, based on the overall cash flows of each project, internal rate of return, project A is 29%, and project B is 23%. If you calculate the internal rate of using the Excel. So then, if you decide on only based on internal rate of return, okay, so then higher internal rate of return means that you have more chance to have that profitable, more chance of a profitability, right? So then project A is gonna be sorry, more preferable than project B, right? Higher internal rate of return is always better than lower internal rate of return, right? Higher rate of return is always better, right? But net present value may indicate differently. If the internal still, the present value is based on the cost of capital, right? So if the cost of capital is 0, then project B has more net present value. If you actually calculate using this discount rate based on this cash flows of project A, B. So up to require 10% of cost of capital, project B shows a higher, not project here, sorry, up to here, okay. Up to 5%, project B has a higher net present value than project A, right? So if your cost of capital is or for example 5%, then since the net present value of project B is higher than the project A, even though project A has a higher internal rate of return than project B, you should suppose take project B, right? Because the present value is higher. B's have the present value higher than project A. But if the discount rate, cost of capital is higher, 10% or 15%, 20%, right? So then project A is higher, has higher than A has a higher net present value than project B. Then there's no more conflict. The internal rate of return and the present value goes along together, right? So so you can see that you can see the effect on the present value and internal rate of return based on the cash flows, okay, and what cost of capital you're gonna have, okay. This is cross rate. Cross 11.07% is cross rate of return. Cross rate of return is calculated using the difference of these two difference in cash flow between the two projects. So year 1, year 0, 0 difference, and year 2, $40 of difference. Year 3, 0. Year 2, 0. Year 3, 10, minus 10. Like this, minus, okay. 60 minus 20, right? So year 4 minus 40. So based on these cash flows of difference between the project, you can get its own internal rate of return of different differences in cash flows. Then that internal rate of return is 0.07%. Then if discount rate is lower than 11.07%, then you are supposed to have, then there is a conflict between net present value and internal rate. Oh, just a minute. What is happening? Why this number is oh, 8.32. Sorry, that 11 point. 8.32. So based on this difference, the cross internal rate of return is 8.32. Okay. So okay, 8.32. 8. The point. Okay, so if the recovery rate of return is low, if the cost of capital or recovery rate of return is lower than 8.32, then there's a difference in conflict between net present value and internal rate of return. But if the recovery rate is higher than this cross internal rate of return, 8.32, then there's no conflict between the two. Okay. Any questions? Am I too fast?
No, Professor.
Professor, I have a question.
Yeah.
Since we may need to use Excel to figure out the NPV, so do we need to use the Excel in our midterm?
No, I'm not. I'm not gonna ask you to. Yeah. I'm not gonna make any questions that requires to use the financial calculator or the Excel. As I said, I'm gonna more focus on your understanding on concept rather than your ability to the current numbers. Okay. The reason is that okay. In the end, the corporate finance, yeah, I understand many of you may understand, okay, corporate finance is dealing with the numbers, then you should be able to get some specific numbers, accurate numbers based on the data, right? But for me, at the end of the day, it is very conceptual, and the numbers is always kind of a ballpark numbers. I mean, how can you be sure that the future cash flows will be certain, right? It is very subjective area, and the cost of capital, as you may see, was very subjective, and so once the cash flow is very subjective, then all other numbers are very subjective. Ballpark numbers, just forecasting based on forecasting. Okay, so in some sense, in the corporate finance, the numbers depends on who is gonna prepare for the project, for the financials. Okay, financial of the project. So that's why I wanna put more focus on your understanding of concept, and that is gonna more useful in the end when you actually need to use some your knowledge on the financial corporate finance. Okay, so no Excel, no financial calculator. But if you guys have interest in taking on some qualification credentials such as CFA or CPA, then just for the examination purpose, it is important to to get a exact numbers from the questions. So anyway, for this midterm exam, no Excel, no financial calculator, even the final. Yeah. Any other questions?
Yeah, thank you, Professor. I have another question for our midterm. So our midterm will include all the lectures we had before our midterm, right?
No. I think I said that the midterm is gonna cover the cover up to the staff equity valuation, right? So this cost of the capital budgeting is the part for the final. From cost of capital budgeting, from capital budgeting, the final is gonna cover.
Okay, thank you.
Okay. Any other questions? You guys understand the conflict between internal rate of return and NPV? And yeah. Okay, I assume your silence is no problem, right? We understand the concept. Modified IRR. So yeah, so IRR has this kind of a problem, such as multiple rate of return and some conflict between NPV, conflict with the NPV. Yeah. So some people come up with some different types of IRR, which is called modified IRR. But in reality, it's not very popular. Okay, so so if you are interested in that, you can look up into in the textbook to find out what modified internal rate of return. But the concept is basically the purpose of internal modified IRR is to minimize any impact of cash flows on the internal rate of return, such as multiple internal rate of return or conflicts with their present value. So to avoid that kind of problem, eliminate that kind of problems, they came up with some method, but I don't know, they are really useful. So I'm gonna skip this part, okay? Okay, let's take on this question. No, I'm gonna leave it to you guys. Okay, so think over this question. Then we will get back to this question in the beginning of next lecture. So please read this question and think it over. Okay. Please have time to think over NPV and IRR. Okay. Then we're gonna discuss in the next lecture the answers. Okay. Okay. So we've kind of finished up the previous lecture, previous slides, and then this is a new slide for this lecture. So project cash flow. Okay, we keep talking about discounting cash flows to the present value, to the present. But we didn't talk about how to get cash flows, right? So this is how we get the cash flows from the financials of the project. The project cash flows is project operating cash flow. Operating cash flow is the cash flows you get from the operations of the project. If the project is manufacturing the cars, electric vehicles, then the cash flows from manufacturing and selling the cars are the operating cash flows. Minus the project project change in net working capital. Net working capital is, as you may recall, ending net working capital minus beginning net working capital, right? And minus project capital spending. You want to keep making additional spending over the life of a project. So then the capital spending should be subtracted from operating cash flow. Okay. Okay, basically, if you have a project, okay, then you have, as I said here in the beginning, you are supposed to have a revenue, right? Revenue. And let's say, okay, revenue. And let's say expenses, okay? The revenue is not always the same cash inflows. Because of the accounting accrual method. So in the income statement, right, you have a revenue and expenses, blah, blah, blah. But you sometimes, I mean, not sometimes, the revenue is recorded when you make sales, right? But the cash is not collected upon the sales of a product. Usually, account receivable is recorded on the statement on the book, right? So then, account receivable is going to be part of the working capital. Likewise, when you purchase materials, you do not always pay cash for the materials. Okay, you want to have account payables. So you want to delay your payment for the materials you purchased. So then account payable is part of the working capital. So working capital is a short financing in the operations. Okay, so this short finance difference in changes in short financing has impact on cash flows. That's why if there's any changes in the working capital, we deduct. Then why we have this negative sign? Because when you calculate the changes in that working capital, we are gonna deduct beginning net working capital from ending net working capital. And if that working capital is positive, okay, this means that current asset is higher than current liability, right? So if you have a positive asset, more asset than liability, current asset, more current asset than current liability, it means that you have less cash. Why? For example, let's say you have a more account receivable than accounts payable. Just assume that 100% of a current asset consists of account receivable only, okay, and current liabilities consist of only account payable, right? So then, if accounts receivables if you have more account receivables than account payable, this means that you have less cash. Why? Because you haven't yet collected the cashes from the sales of product. Okay, and you paid more cashes in purchasing materials or something like that in the production of to generate the sales or revenue. right? So positive net working capital means less cash. That's why we use this minus negative sign, okay? And the capital spending is supposed to be negative. If you have a positive spending, if you have spending, it means the cash outflow, right? That's why we have a negative sign from this product operating cash flow. This is supposed to be positive cash flow. It could be negative, but anyway, we have a negative. We have deducted this change in net working capital and deduct this capital spending from product operating cash flow. Okay. And this product operating cash flow can be calculated calculated by this: earnings before interest and taxes, earnings before interest, tax, EBITDA. We usually call it not EBITDA, EBIT. Okay, EBIT or EBIT, EBITDA. Okay, not this time. Oh. Okay. In short, EBIT, okay? Earnings before interest and taxes. We start from these numbers: income statement, revenue, expenses, gross income, right? Gross income, and operating expenses, okay? And interest and the taxes, and you're gonna have a net income, right? So before interest, before tax is that is called the earnings before interest and tax. Operating expenses already deducted. So we assume that here all the revenues, just for now, or for this operating cash flow purposes, all the revenues, expenses are cash inflows, cash outflows, okay? For the operating cash flow purposes, okay? And part of the operating expenses include the depreciation expenses, but depreciation expenses is not cash outflows, right? Not cash flow. We should add the cash flows. We should add these depreciation expenses to this earnings before interest taxes for the cash flow purposes, right? And tax should be deducted. Okay, tax is a part of the operating. That's why we deduct taxes from operating cash flow. And then we also consider net working capital because we assume all the revenues are cash inflows and all expenses are cash inflows. But actually not. That's why we should consider working capital, changes in working capital. So if the working capital has changed, then we should deduct changes in working capital. And if you made any capital spending is not included in this earnings before interest tax, right? That's why we should separately deduct this capital spending from operating cash flow. Okay. So I think you guys recall this change in the working capital. Okay, increase in the inventory means you purchased the inventories, raw materials, right? For example, so it means cash outflow. Okay, increasing account receivables is also cash outflows. while cash outflow means that their working capital has increased, okay? Because account receivable is a part of the current asset. An increase in the account payable is lower working capital because of account receivable, account payable is part of the account current liability. Okay, so the lower the working capital means more cash flow, and higher net working capital is more cash out. Okay, because net working capital is deducted from the operating cash flows. Any questions up to now? No? Louis Bing Bai, any question?
No.
No? Is this because the reason you guys don't have any question is that it's pretty simple to understand, easy to understand, or I don't know where we are now. Which one you guys on? But in some sense, this may not come pretty straightforward to you guys, because this is kind of new guys to this kind of new to you guys, right? I don't know. Junhyun.
Yes.
Junhyun, what do you think of these further cash flows?
Do you mean like my opinions on it?
Yeah. Level of, yeah. No problems with understanding this further cash flows.
Yeah, until now there's not much problem.
Okay. This is the practice question, the one practice. So as you can see, just a minute. Okay. H. Cochrane Inc. is considering a new 3-year expansion project that requires an initial fixed asset investment of $2.15 million. The fixed asset will be depreciated straight line to 0 over its 3-year tax life, after which time it will be worthless. Okay. The project is estimated to generate $2.32 million in annual sales with a cost of $1.25 million. If the tax rate is 23%, what is the operating cash flow for this project? Okay, so first of all, this 2.23 sales should come first, right? Over the 3 years. So sales 2.32 million comes first, and the expense is I think it is total cost, right? Operating expenses or all sorts of expenses related to this project. So 1.25 million every year. So we consider these two. Yeah, these two are these two are not adjusted for. These two are numbers of the numbers adjusted for cash flows, right? And another information we have is depreciation expenses. Why depreciation expenses? Because depreciation expenses takes the biggest portion in the expenses when it comes to non-cash flow. Okay, so that's why when you consider, I mean, still the operating cash flow is just the ballpark numbers, right? Just take the big items. There may be some other non-cash flows, but compared to depreciation expenses, they are very small. Okay, that's why we first of all, more than anything else, we consider depreciation expense. Depreciation expense is 0.27. How did we get 0.27? How did we get? How did we get 0.27? Maggie? Maggie, you are there? Maggie? No? Benedict? You are there?
Of course.
So how can you get 0.27? 0.72, sorry.
I don't know right now, to be honest.
Okay, so this is depreciation expenses, right? So the question is, how do we get these depreciation expenses of 0.27, 0.72? That's fine. Conhee Kim,
Yes, Professor.
how do we get this number? 0.27, 0.72, sorry. I keep saying 0.27. Connie,
Oh, I don't know.
no idea. Did you guys take an accounting course? Principal, maybe introductory course, accounting. Okay, so depreciation. Do you guys exactly know what depreciation expenses are? Connie, do you know what depreciation expenses actually is? Can you explain what depreciation expenses is?
Oh, no idea. Sorry.
Okay, that's fine.
Professor,
Sorry. Okay.
here's Professor.
Yeah.
Can I explain it?
Can you do that?
Can I explain it?
Yeah. Can you please?
Depreciation expense is the value that we subtract from inventory after some period of time because it loses its value after a period of time.
So could you say again? I couldn't because I have some noises. So could you say again?
So after a certain period of time, the inventory loses some value. So depreciation expense is that, for example, if I have a car after a year, it will lose its value. It's not the same value that I bought a year ago. So we subtract the depreciation expense after a certain period of time.
Okay, yeah, that is a very good way of explaining the depreciation expenses. Okay. Depreciation. And Mr. I forgot your name.
My name is Malik John, Professor.
In short?
Malik John.
Namik John?
Malik John, yes.
Manik John, sorry. So he mentioned two terms. One is depreciation, the other one is value, right? So his understanding is that, okay, so when you purchase the product, when you purchase some property, such as a car, right? So then the purchase price of the car, as time goes by, the value of the purchase, the car is going to decrease, right? So the difference between the initial value of the car, difference between initial value and the future value of the car is gonna maybe could be called the depreciation expenses, right? That could be we could say that okay, once you purchase a car, then the value is gonna depreciate. Okay, so these days as you know, the currency, except for the US dollar, all other currencies losing its value, right? So then we can say, oh, the Korean won is depreciating against the US dollar. Okay. I think that is kind of a common way of understanding depreciation. That is not wrong. That is okay, fine. But here this depreciation expenses is a little bit different from the reduction in value of the property. Okay, this depreciation expenses is purely accounting perspective. Okay, accounting based expenses. So let's take an example. Let's take the example, the car, right? So the company purchased the car for business purposes. Okay, so then the value of the, let's say the company purchased the Mercedes, so 100K, right? Dollar. So purchase price of the car for the business for use is 100K. So value is 100K. Well, after, let's say, some years later, the value of this car, right, Mercedes, this car may be reduced, right, lower than 100K. But we don't know exactly what the value of this car would be. It would be in the market. This is market value, right? Market value of the car, of this used car in some years later. So this difference, right? The difference from accounting perspective is not depreciation, but it's just the differences in fair market value of the car. Differences in fair market of the car. Okay. In the accounting, this depreciation comes from accounting. Depreciation is based on the accounting rule. In the accounting, they set some specific useful life of the product, of the property. So in case of a vehicle, depending on the company policy, they may set the useful life of a vehicle as, for example, 5 years. For example, so they have a specific useful life of some specific property. So for this vehicle, 5 years. Then within these 5 years, this 100K is gonna be allocated as expenses. Okay, over the 5 years, this 100K, this cost is allocated as expenses. When you initially purchase this car is not expensed. This car initially recorded as asset. Okay. But as you use this car for business purposes, over the 5 years, part of this cost of 100K is gonna be expensive to match the revenue generated partially from the use of this car. So conceptually speaking, this $100K of car has contributed to generate some revenue over the 5 years. That's why they allocate the cost of this car over these 5 years. So if they use a straight line method, straight line to zero means that after 5 years, the value of this, there's no residual value of this car. So after 5 years, this whole cost of this vehicle should be 100% allocated as a depreciation expense. So if you use a straight line over the 5 years, every year you're gonna have a 20K of depreciation expenses. Then in 5 years, on the book, not market value, on the book is gonna be 0. But in the market, this vehicle is gonna have still value, right? That's the market value. So the market value, there's a difference between book value and market value. Book value and market value. So that's the another area. So when it comes to depreciation, here, this is the allocation of cost of the property. For example, here in vehicle, that's the depreciation. Okay. Okay, so because the depreciation expense is important when it comes to the cash flows, so that's why I said some time had an opportunity to explain a little bit more further about the concept of depreciation expense. Any questions? I'm gonna follow on the remaining slide in the next lecture. Any questions? No? Okay, so then see you next Monday and have a great weekend. Thank you.
Professor.
Yeah.
So I'm trying to rewatch all the videos of the previous lectures, but the smart system doesn't seem to load them. It's not just
you guys can watch them on YouTube. So
but we don't have the link because you embedded it onto the system.
Okay,
so
then I will send you a YouTube link on I'm gonna send you emails. Okay.
Yeah, so I want to watch all from the start to prepare for the midterm. So yeah.
I'm gonna send you all and send the YouTube link to all of you guys.
Okay,
Any other questions? No. Okay, so have a great weekend ahead. Okay, see you next Tuesday. Yeah, thank you,
Professor.
Yeah,
Thank you, Professor.
bye.
Same to you.
Sorry.
Thank you, Professor. The same to you.
Oh, okay. Thank you very much. Okay, thank you very much. Bye bye.